Okay, so the sole proprietorship is the simplest form of business organization. Here, the business and the owner are one and the same, and anyone who creates a business without designating a specific form of organization is basically doing business as a sole proprietor. What are the advantages? One of the advantages of a sole proprietorship is greater flexibility. The owner makes all the decisions and operates the business without any formalities. The disadvantages of this is there are no limits to his liability. He is responsible for the debts and obligations of the business. Another disadvantage is his ability to raise capital while maintaining control is chiefly limited to borrowing funds. If he brings another partner in, it would convert the business to a partnership. If he would like to issue stock, it would require incorporation, and this again would create another form of business. Regarding partnerships, when does a partnership exist? Well, a partnership is an association of two or more persons that carry on as co-owners of a business for profit. Intent is very significant in this particular case. The three essential elements are the sharing of profits or losses, a joint ownership in the business, and equal rights in the management of the business. It's important to note, however, that joint ownership of property or a sharing of profits or a sharing of losses does not alone create a partnership. However, sharing of both profits and losses may qualify. With regards to partnership formation, the parties may agree to any terms as long as they're not illegal or contrary to public policy. The duration of the partnership depends. They can be for a term or they can be at will. A partnership for term ends on a specific date or the completion of a particular project. Dissolution without the consent of all the partners before the term is considered a breach of the agreement. Now, if there is no fixed term, the partnership is considered at will, and any partner can dissolve the firm at any time. Now, you can also have partnerships by implication and partnerships by estoppel. Partnerships by implication means there is no contract, but you agree to share in the profits and losses. Partnership by estoppel is when a person represents himself to be a partner in either an actual or alleged partnership. He then becomes liable to any third party who acts in good faith reliance. Under such situation, the partnership is a partnership only with regards to those particular acts and not with regards to other third parties. Okay, partnership's ability to bind. Every partner is an agent of the partnership and may bind that law firm or that business to contracts with any third parties. Only in situations where a third party is aware that a partner's authority is limited will the liability of that business also be limited to that same extent. There are, however, certain things that cannot be limited by agreement. The apparent authority of a partner to bind a partnership in dealing with third parties cannot be limited by agreement between the partners if the third party is unaware of such an agreement. The rights of partners. Partners have management rights. All partners have equal rights in management. Each partner has one vote and the majority rules in most matters. However, for extraordinary matters, they often require unanimous consent. Every act of a partner concerning the partnership's business and every contract signed in the partnership's name will bind the firm. Let's discuss limited liability partnerships. The key difference between a general partnership and a limited liability partnership is the limited liability of the partners. That is, of the limited partners. The LLP will allow professionals to avoid personal liability for the malpractice of other partners, whether the liability of the partnership obligation arises in contract, tort, or otherwise. The formation of a limited partnership is a public and formal proceeding. There must be two or more partners, and at least one of whom must be a general partner, and a certificate of limited partnership must be signed and filed with a designated state official. In such situations, the liability of the limited partners is limited to the capital that they contribute to the firm, but this limitation requires non-participation in the management of the partnership. If at any time the limited partner participates in the management, he will then be liable as a general partner. Okay, let's discuss some points regarding limited liability companies. Advantages of the limited liability company is that it is a hybrid form of business that offers the limited liability of the corporation as well as the pass-through advantages for tax purposes of a partnership. The disadvantages are that there is a lack of uniformity among the state LLC statutes and there is a lack of case law. Generally, the management of an LLC may either be manager-managed or member-managed. Manager-managed LLCs occur when they designate a group to run the business. Member-managed LLCs is when all the members participate in the management. Now, finally, a couple points regarding franchises. A franchise is an arrangement in which the owner of a trademark, a trade name, or a copyright has licensed others to use it in selling goods or services. A franchise is generally legally independent, but economically dependent on an integrated regional or national business system of the franchisor. There are several different types of franchises. These include distributorships, chain-style business operations, and manufacturing arrangements. Franchisors can terminate the franchise if they're acting in good faith and it is for cause. Cause can include death or disability of the franchisee, insolvency of the franchisee, or breach of a term of the franchise agreement. For example, failing to meet specified sales quota can constitute a breach of the franchise agreement.